Welcome to the webinar. My name is Andika Duncan. I am the broker of Showstopper Realty, and this webinar is about mortgage application and approval for first-time home buyers. Please subscribe to my channel for more information and like this video and share it with others. Thank you. What will we discuss today? Getting pre-approved for a mortgage, understanding and calculating your income. Do you qualify for a mortgage? Credit requirements, how to keep a good credit score, and what documents you need for mortgage approval. In this series, this is part 1 mortgage application. The next part will be buyer representation and home search. Part 3 is making an offer and the escrow process. And part 4 is the responsibilities of a new homeowner. So who is considered to be a first-time home buyer? A first-time home buyer is an individual who meets any of the following criteria. An individual who has had no ownership in a principal residence during the 3-year period ending on the date of the purchase of the property. This includes a spouse. If either meets the above test, they are considered first-time home buyers. A single parent who has only owned with a former spouse while married. An individual who is a displaced homemaker and has only owned with a spouse. An individual who has only owned a principal residence not permanently affixed to a permanent foundation in accordance with applicable regulations. So that would be a mobile home. And last but not least, an individual who has only owned the property that was not in compliance with state, local, or model building codes and which cannot be brought into compliance for less than the cost of constructing a permanent structure. Okay, let's talk about getting pre-approved. In order to start looking at homes in person, your real estate professional will advise you to get pre-approved for a mortgage if you need to get a loan. This will confirm your budget. When you put an offer on a house, you will have to provide that letter along with your offer, or sellers will not really consider your offer. Pre-qualified versus pre-approved. What's the difference? They sound the same, but the difference is key if you're buying a home. Pre-qualification can be done over the phone or online, and there's usually no cost involved. It's also quick, usually taking just 1 to 3 days to get a pre-qualification letter. Keep in mind that loan pre-qualification does not include any analysis of your credit report or an in-depth look at your ability to purchase a home. It's based solely on the information you hand over to the lender. What does pre-approved mean? To get pre-approved, you complete an official mortgage application and supply the lender with the necessary documentation to perform an extensive check on your financial background and current credit rating. Some lenders charge an application fee for pre-approval, which typically runs between $300 to $400. After reviewing your finances, the lender can pre-approve you for a mortgage up to a specified amount. You'll also have a better idea of the interest rate you will be charged on the loan, and you might be able to lock in an interest rate. With pre-approval, you receive a conditional commitment in writing for an exact loan amount, allowing you to look for a home at or below that price level. Understanding income. The key term here is debt-to-income ratio, DTI. To determine your debt-to-income ratio, simply take your total debt and divide it by your income. For instance, if your debt costs $2,000 per month and your monthly income equals $6,000, your debt-to-income is $2,000 divided by $6,000 or 33%. No more than 43% of your gross pre-tax income that is needed for your approval. and that will also include your principal, interest, tax, and insurance payment. So if you are not a homeowner now, you don't pay any mortgages, you will have to calculate all of these extra expenses into your debt to income ratio. Gross income. So of course it includes your base salary, overtime, bonuses, commissions, social security income, retirement income, and lenders go by the 2-year average. So how do they calculate the income? Let's look at a scenario. A base income is $60,000 a year, which is $5,000 a month. The 43% of $5,000 is $2,150. Let's say that in this scenario, you also have about $20,000 in bonuses, but the lender will only calculate with 70% of that because this is not a consistent income. So 75% of $20,000 is $1,250 a month. Your total debt, including your mortgage and other debts, cannot exceed this total qualifying income amount. So let's look at other calculations. When you apply for a mortgage, your mortgage will be $1,500 a month. Property taxes, $500 a month. So when you are looking for homes, pay attention to the taxes. Your real estate agent can tell you the taxes paid for each individual home. Home insurance is $100 a month. And then the lender will pull your credit and look at all your other debts. It shows that you have a $400 a month car loan, credit card payments equal to $100 a month, and a personal loan, which is also $100 a month. If we add all this up, the total will be $2,700, which is over the limit of $2,637.50, which is your qualifying income in this scenario. If this is the case, your lender will ask you to pay off some debt to reduce the debt amount so you can qualify for the mortgage. Do you qualify for a mortgage? When you apply for a mortgage, your debts will matter and also the property tax and the home insurance. So you have to calculate all of these expenses into your debt. Here are the credit requirements. Credit is very important when it comes to applying for a mortgage. Your credit score basically is telling the lender how responsible you are when it comes to your financials. Your credit score influences your mortgage interest rate, and it will also influence the amount of down payment you are required to purchase a home. Minimum 620 credit score is required in most cases. However, a higher down payment is needed if your credit is low. A very good credit score is 725 or higher, and this will give you preferred rates, fees, and a lower down payment requirement. Determining your credit score. In the United States, we have 3 different credit bureaus: Experian, Equifax, and TransUnion. Let's see in this scenario how the lender will determine the actual credit score. Lenders use the middle score. They don't use the top or the bottom score. So here we have a 680, 720, and 677. The top score is 720, the bottom score is 677, and the middle one is 680. So in this case, they would use 680. In case of 2 or more borrowers, here is another scenario. Lenders will use the middle score and they will use the lesser one. So in this case, buyer 1 has a middle score of 680 and buyer 2 has a middle score of 760. Unfortunately, they will use the 680 credit score. So what is a FICO score? The name FICO comes from the company's original name, the Fair Isaac Corporation. FICO specializes in what's known as predictive analytics, which means they take information and analyze it to predict what's likely to happen. In the case of credit scores, FICO looks at a range of credit information and uses that to create scores that help lenders predict consumer behavior, such as how likely someone is to pay their bills on time or not, or whether they are able to handle a larger credit line. So how do they figure out your FICO score? The biggest part of your FICO score will be your payment history. That's 35%. The second biggest amount is the amounts owed or your debt. 15% will be the length of credit history. And 10% will be the types of credit used. And 10% of new credit lines or inquiries. So how you can keep a good credit score? As we saw, 35% is the payment history. So always pay your credit cards on time and make at least the minimum payment. Total debt or amounts owed. Keep your credit card balance below 30% of credit limit. Length of credit history. Don't close old credit cards. You can keep a zero balance. If you are required to make purchases, make a very small purchase to keep it alive. And remember to pay it off. Types of credit used. Lenders like to see different types of credit used, such as credit cards, car loans, or personal loans. New credit. Opening new credit accounts is a little dicey as it may enhance your FICO score or it may dampen it slightly. If you open several credit cards in a short time frame, then this could indicate you are struggling financially. So what documents will you need for mortgage approval? Your lender's goal is to assess you as a borrower and ensure you can make your payments on time. As such, you will need to provide them with documents that paint an accurate picture of your credit worthiness. The typical home buyer will have to provide information about their assets, debts, income, and credit history. However, the exact documents lenders need could vary from person to person. Depending on your unique situation, here are 7 documents you may need when applying for a home loan. Tax returns. Lenders generally want to see 1 to 2 years worth of tax returns. This is to make sure your annual income is consistent with your reported earnings through pay stubs and there aren't huge fluctuations from year to year. Proof of income. Lenders may ask to see your pay stubs from the past month or so. If you're self-employed or have other sources of income, such as child support, you may need to show your lender proof through 1099 forms, direct deposits, or other means. Bank statements and other assets. Lenders typically request these documents to make sure you have several months' worth of reserve mortgage payments in your account in case of an emergency. They also check to see that your down payment has been in your account for at least a few months and did not just show up overnight. Credit history. In order to assess you as a borrower, lenders often pull your credit report with your verbal or written permission. A photo ID. You likely need to provide a photo ID such as a driver's license. This is simply to prove you are who you're claiming to be. Gift letters. Your friends and family might help you buy a house by giving you money. If that's the case, you'll need to provide a written confirmation the money is indeed a gift and not a loan. The documentation should list their relationship to you as well as the amount of the gift. Renting history. For buyers who don't already own a home, many lenders will request proof that you can pay on time. My personal recommendation is based on customer service experience for my buyers and as a real estate professional. Send an email to lenders@showstopperrealty.com for a full list of recommended lenders. This will send you an auto response. This inbox is not monitored, so if you have additional questions, please contact me at Andika, it's Andika, at showstopperrealty.com. You can call me at 214-495-1951 or leave a comment under this video. Thank you again for your attention. Please subscribe to this channel, like this video and share it with others, and I see you in this part 2.